Hi and welcome to ECCB Connects. This week we'll be speaking with Niall Pistana, Deputy Director in the Banking and Monetary Operations Department. We'll discuss how the ECCB makes money and how international events affect the bank's finances. Stay with us. We'll continue in a moment.
Do you own or manage a business? Interested in saving time and money? How about expanding your business? Then the Dcash Merchant app is for you. Receive digital EC payments instantly from Dcash customers anywhere via your smart device. Create invoices and track transactions easily in the app. And avoid the hassle of handling physical cash. Visit dcashec.com today for more information and to sign up. Dcash, the digital version of your EC dollar.
Niall, welcome to ECCB Connects.
Thank you, Sherman. I'm happy to be with you.
Niall, you are part of the bank's investment unit. You and your team, you are responsible for managing the bank's investment, its portfolio. And of course, you are responsible for helping the bank earn its income. How do you do this?
The lion's share of the bank's income is derived from the investments that we make of the bank's foreign reserve assets, right? So we have a large pool of assets that are meant to back our peg, the EC dollar, against the US dollar, and we invest those funds on the international bond markets, fixed income markets, and we earn interest on those investments. And that's where the lion's share of the bank's income comes from.
You spoke about the pool of foreign reserve. Where does the ECCB get that pool of reserves?
Those reserves come from any foreign currency inflows that come into the currency union. So for example, tourism-related activity, we have visitors come to our shores and they pay for services in their currency. Those foreign currency inflows grow the foreign reserve assets. We all have family overseas, so we know that family can send funds down to us in foreign currency. Those foreign currency notes and balances that we receive also help to grow the foreign reserves.
So the ECCB gets its, like you say, lion's share of its income from investments, and the ECCB, like other central banks throughout the world, tend to be conservative institutions. They're very concerned about risk and protecting the wealth. What types of investment does the central bank hold?
The central bank's investments, the foreign reserve investments, are invested in fixed income instruments. So these are, in the general parlance, called bonds, right? So we essentially lend money to foreign governments, in particular the United States government, and they pay us interest on the money that we lend to them. So we collect interest receipt, interest income on the principal that we lend to the United States government. So that's the lion's share of our investment asset. You spoke to risk. Because it's funds that have to be made available on demand. As you can imagine, someone walks into a bank and demands foreign currency. The bank has to be in a position to provide them that foreign currency.
And when this bank uses commercial bank?
A commercial bank, yes. So similarly, if the commercial banks require foreign currency from us, right, in exchange for domestic currency, we have to be in a position to provide that foreign currency. Similarly, for the member governments, if member governments require foreign currency to meet their needs and they come to us, we have to be in a position to meet those needs. So for that reason, the investments that we make typically are extremely liquid investments, meaning they can be sold and we receive the proceeds within 1 or 2 business days, regardless of the size of the sale. We also have to be very careful about the credit quality of the investments that we make. So typically, our foreign reserves are invested in the highest quality, highest rated assets, AAA rated assets. right? That means that the probability that we won't get our principal back is extremely low. So from that perspective, we're managing the liquidity risk and we're managing the credit risk. The last risk we try to manage is what's called market risk. That is trying to get into investments that don't have a lot of up and down movements in their price. In market terms, that's called volatility. So we invest in very low volatility assets. So in a nutshell, that's sort of the risk management framework.
But there is still that level of risk. And with the investments being the main source of income, what measures are in place to safeguard losses?
It's a very good question. So as part of the reserve management framework, what we do every year is we have a look at the investments in total, and we do a projection on what we think the expected volatility and return will be over the next 1 to 3 years, right? The bank, again as part of the risk management framework, has a very clear articulated appetite for losses, what we call the risk tolerance. And what we're doing every year, every 12 months, is comparing what we expect to happen against what our appetite for losses are. And we then make a determination as to whether or not we need to make a change in the investments that we hold.
So you mentioned an important term there, losses. And this year, the ECCB has reported that for the financial year ended 31st March 2022, the bank recorded a loss of $49.1 million. But this is not the first time. The first time in the bank's history that it recorded a loss was in 2014, and that went for 3 years, 2014, 2015, 2016. And that came on the heels of the global financial and economic crisis. So these external and international events, how do they impact the bank's finances?
Excellent question. So the circumstances this time in terms of the loss that the bank has realized somewhat different to what it was back in 2014, coming out of the financial crisis that started in 2008. Circumstances this time around are related to, of course, the COVID-19 pandemic. However, there's a common catalyst for the loss, right? And that catalyst is interest rates globally fell dramatically in the wake of both of those events. So in 2008, the Federal Reserve in New York, which is the central bank for the United States, they, in an attempt to support their economy from the ill effects in the economy from the financial crisis, they would have lowered interest rates to near zero. So that happened in 2008, and that happened in March of 2020 with the declaration of the global pandemic. As you know, health services around the world, United States included, ourselves included, had to restrain movement of persons to constrain the spread of the pandemic. Yes. So that brought economic activity to a crawl. So to support these economies, their respective economies, the United States in particular, would have lowered interest rates to zero, to lower borrowing costs, to sort of make things easier for persons to make it through this difficult time. For fixed income investors like ourselves, and especially conservative fixed income investors, what this meant is that our interest income essentially dropped dramatically, and dropped dramatically in a very short space of time. So we're making less interest. So as we all know, profit, expenses, taken away from income. If the income side is falling, then your profit is declining. And that's what we found, that's the situation we found ourselves in, both in 2008, following 2008, and following 2020. So different circumstances. One was a financial crisis that led to a recession. This one was a pandemic which led to a recession, but the response was the same from the Monetary Authority in the United States. which was to lower interest rates to near zero to support the economy. It means then that investors in those assets are making much less income.
With the global financial and economic crisis, that was 2008, but the bank, the ECCB, did not record a loss until 2014. With this one, the pandemic hit in 2020 and the bank recorded a loss almost immediately. What was the difference then?
The major difference is the speed at which the United States economy would have recovered, and the Federal Reserve, again the central bank in the United States, reaction to that. So in 2008, what you had was a more gradual recovery, right? In 2020, what you had was a much more sharp recovery. I mean, the recovery was quite sudden. Added on top of that, what we now know was that shutting down the global economy contributed to various things. For example, supply chain disruptions, right? And so you had basically scarcity of goods, and you know, when you have scarcity of goods and people are trying to get them, the price tends to go up. So what is that called? Inflation. So we have very high inflation globally right now, and the central bank, one of the main mandates of the central bank is to control inflation. In the United States, the Fed has a dual mandate, which is to support employment as well as price stability, which speaks to the inflationary side. So we've seen inflation skyrocketed in the United States. It's at a 40-year high. So in an attempt to mitigate that, the Fed has been quick to raise interest rates, again from a very low level, very aggressively, to combat inflation, to rein it in. So for us, the impact has been that while our interest income is set to improve, that's a good thing. In the short to medium term, it means that the prices or the valuation of the assets we hold will fall. There's a rule in fixed income investing: as interest rates rise, prices fall. So what you've had this time around is a very sharp stop in economic activity, a lowering of interest rates to support the economy, and then coming out of that, a sharp recovery, and in response to that, a sharp move upward in rates. So what you'll find is, although our interest income is improving, the valuation of the assets remains under pressure as long as interest rates are going up.
So back in 2014, after that crisis the ECCB had lost 2014, 2015, 2016. Then it recorded profits for 6 years with record profits last year, and now a loss. What is expected? Do we expect something similar as in 2014, where you will have like 3 years of losses? Is there hope?
Okay, so it's very difficult to answer that question with any degree of precision or accuracy. What we can say confidently is that our interest income will continue to go up as interest rates have continued to climb, and we are seeing that at the moment. The uncertainty lies in how long will prices of the assets we hold remain under pressure. Because remember, we have inflation rising, we have the central bank in the United States making a very serious and concerted attempt to control inflation. That means they're going to continue to raise rates. As long as interest rates are going up, prices are going to remain under pressure. No one knows exactly when the Fed will stop raising rates. Once the Fed stops raising rates and inflation is under control, it means the valuation of our assets stabilize, and at that time we'll be earning much higher interest income than, let's say, we've been earning over the last 2 years. Profits will return. But until the Fed stops raising interest rates, which is connected to the fight against inflation, we really can't answer that question definitively. But I think the point that needs to be made is that the situation has improved in a sense that our interest income is much higher now than it was 2 years ago. And the Fed appears to have things under control in terms of fighting inflation. Market has confidence in the Fed fighting inflation, and therefore we think they will be successful, and at some point prices will stabilize and profits will return.
So there's some hope.
Yes, definitely, there's hope.
Great. So Niall, we have been looking at the investment from an institutional level, particularly the ECCB. We also encourage our citizens and residents to invest, save and invest. How do these international events affect investors, like the local man?
Okay, to answer that question in a very detailed way, one would have to have a very good understanding of what those investments are. But certainly, if one of our citizens had made investments overseas in the international fixed income markets like we've been talking about, or even in the equity markets in the United States, for example, those investors will be facing similar challenges, let's say, in terms of return, certainly over the last 8 months or so, right? As prices have reacted to what's happening with inflationary pressure. While we at the bank, for the foreign reserves, we don't make investments in equities because that's a little too volatile for our risk appetite. Someone who is invested in US stocks, for example, would be experiencing at the moment significant losses. Losses that would far exceed, for example, the losses that we're experiencing in our very conservative fixed income portfolio. So I think in investing, there are a few rules to follow. You want to have your money diversified. I think we're currently going through a very difficult period in time where a great many asset classes are actually falling in price, but one always has to keep in mind what your investment horizon might be. So if your investment horizon is long term, you can probably stomach this situation. You can take these losses because you know those funds aren't really needed right now. If your investment horizon is very short, then perhaps you need to consider investments that are far less volatile, much shorter term in terms of their investment horizon, right? Their maturities have to be much shorter, so you're not exposed to these pricing movements that you have that most investors are currently experiencing. So it's a choice that each investor has to make. And as we were speaking earlier, we have quantified what our appetite is given the objectives for the foreign reserves: liquidity, right, high credit quality, right, and low volatility. That's led us to invest in a particular type of asset, right? It would be the same for any other investor given what they're trying to achieve in terms of their investment objectives.
It really boils down to risk and how much risk you can take.
Yes.
And how you manage your risk.
Yes. And for us, given what has transpired, I mean, I think most persons would agree we're in a very unique time. There hasn't been a global pandemic of this nature in recent memory. For us, the importance of assessing our portfolio's compliance with our appetite for risk, that has only increased since the pandemic was declared. So I would have mentioned earlier to one of your questions about how we go about making the decisions on what types of investments to make, right? So that typically happens once a year. But since the pandemic was declared in March of 2020, that's something we've been repeating every 3 months. So it's being done on a much more higher frequency because we are aware that the risk that's currently posed is much higher than during normal times.
You're being more vigilant.
Yes, more vigilance is required, as well as increased communication with all stakeholders at the bank.
Niall, thank you very much for speaking with us.
My pleasure,
ECCB
Shamila.
Connects.
And now for this week's financial tip.
Financial security and good money management are important in these uncertain times. To achieve financial security and manage your finances prudently, budgeting is paramount. A personal monthly budget allows you to know what, when, and how much you are spending. Keeping proper records allows you to track, monitor your budget to enable you to make sound financial decisions daily.
Here's where we end this week's episode of ECCB Connects. Thanks for watching, and we invite you to join us next week when we'll bring you the final episode of Season 19. Remember, ECCB Connects is produced by the Eastern Caribbean Central Bank to share with you who we are, what we do, and how we serve you.